Thank you for joining us for our quarterly webinar. I'd like to start by observing a moment of silence for our company founder, Jack Burney, who recently passed away. Jack was a great man, innovator, and leader, and it's an honor to carry his business and vision forward. The Delta variant of COVID-19 now accounts for 83% of US infections. This is causing another surge of infections, mostly of the unvaccinated. However, breakthrough infections are also occurring and account for roughly 1% of COVID deaths. The recent stock market disruptions are related to the economic impact of this latest surge. Most economists still forecast robust economic growth this year and next. However, the bond term spread forecasts much lower growth. This disparity creates uncertainty, leading to market volatility. With 56% over 12 and 75% of the over 65 US population vaccinated, a repeat of last fall and winter's surge isn't possible. Reasonable is to expect localized economic disruptions, especially in under-vaccinated areas. This will dampen our economic rebound to an extent which should still allow for robust growth. In addition to his customary review of asset class returns, Adam will address the Congressional Infrastructure Bill and its expected economic and tax impacts. Andy will provide a size and style update and share some details of an informative cryptocurrency blog we recently posted. Adam?
Great, thank you, Lowell. Good afternoon, everyone. We're going to start by looking at a broad review of the asset classes for the quarter and their respective returns. As you can notice, another consecutive quarter of positive performance for most stock categories with not much variation in between them. The top performing stock asset class for Q2 was global real estate, and I think the interesting part of that is who would have thought a year ago we'd start to see these types of returns again from real estate based on what we were all saying and discussing about going to work in the office environment. But again, just another reminder about the uncertainties around short-term market movements. But overall, a positive tone to markets for the quarter and a continuation of what we've seen for the past several quarters. I think the real story for Q2 was over in the bond market, where it continues to be resilient in the face of a lot of concerns about interest rates going up due to the strong recovery we're seeing in the economy. So last quarter, we noted very specifically that bonds saw their first full quarter of negative performance in quite some time. And we saw a bounce back in this quarter with both domestic and overseas bonds posting positive returns very much in line with their longer term averages. Certainly not something we would expect to see continue over the intermediate term with a stronger economy, rising rates, and a higher appetite for stocks. But nonetheless, bonds, especially over the past month or so, as you've seen a little bit more volatility in the stock market, have provided a bright spot. And for those of you thinking, specifically within your allocations, domestic equities to international and allocating across various spectrums of the bond market, now after the last year, it's probably a good time to revisit some of the asset allocation decisions you're making in terms of how do I want to allocate across my stock portfolio and how do I want to allocate and spread risk across my bond portfolio. And that's something our team is able to help discuss with you. But certain things we're looking at right now is the allocation of domestic to international in our equity portfolios, as well as looking more closely within the bond allocations, where are the smartest places to take risk right now, and where might we want to peel back some of our exposure. Specifically, if you look at some of the higher yielding bonds out there in the market and, the risk associated with, maybe some shorter term volatility. But, Andy, if we look back over the longer term trends, not much has really changed there. If you go back over 1, 5, and 10-year periods, looking at the same categories, the big story here has been what's happened over the past year with all major equity asset classes up well over 30%. a very broad rally, both domestic and abroad. Certainly, we all know it's part of the recovery from what happened last year, but very resilient and fairly consistent performance. With a flatter backdrop in the bond market. If we look out 5 and 10 years, you see what a lot of us have noticed. Domestic equities continuing to do very well and trending over time, and you see the continued 10-year lag between domestic and overseas stocks, and that's something, again, as I mentioned, in terms of that asset allocation conversation you're having and looking at as you're reviewing your portfolio. What are the next 10 years going to look like? That's a conversation we're having internally, and part of the the reviews that we're taking on with clients as we're trying to make those decisions. But overall, if you look at what's happened market-wise over the shorter term and going back a little bit further, certainly strong and slightly above average returns across the board. So on an economic note, I want to point out some of the positives and the negatives, or what are the green flags and red flags as it relates to what's happening in the global economy. And I would first start by saying, don't get lost in the data. Now's a great time to put numbers aside, because if you read the headlines, you hear monthly numbers being read on things like inflation, economic production, and everything else in between as it relates to the inputs of the economy. But don't get lost in the data. Go out and see this for yourself. Whether it's trying to plan a trip, going to Home Depot and trying to buy something and learning that it's going to take 3 to 6 months to get delivered. Or if you're really brave, you go out and you try and buy a house right now, and you see just how strong and active things are out there in the economy. It's something that I think even at this point is surpassing expectations for what we had a year ago. And I think a big reason why the markets continued to grind higher through some of the other uncertainties we've had behind us. And if I had to pick one positive, if you look at the economy, what's the best thing that's happening that probably isn't even getting enough attention? And that has to be the consumer. Households in the U.S. are stronger than they've ever been. You have almost 140 trillion in household net worth. And that is, at this point, if you compare that to GDP, that's almost 600% of GDP in terms of household net worth and assets that are out there and available to be contributors to the economy and the market. And even with that, and you want to gauge the quality of that and some undertone to what makes that even better. You've got debt being paid down rapidly. Things like credit card debt down 20% over the last several years, and you've got a household savings rate clipping a little bit over 15%. So if you look at what's causing demand for the market and what's causing demand for the economy, people have done a fantastic job repairing their balance sheet and putting themselves in a better position post really the great financial crisis. So this isn't a 12-month phenomenon. This is something that's been brewing over time, and a big reason why the housing market's doing as well as it has, and a big reason why now that things are back open, you see the pent-up demand and people out there really actively engaging in the economy. If you think of two concerns, what are the areas that I think are getting a lot of attention and question marks from investors? Obviously, inflation has been a big one. In the first quarter, we saw rates go up and the economy start to heat up. The inflationary chatter was probably a little bit greater than it is now, but plenty of concerns around inflation with the trillions of dollars that have been pumped into the economy and some of the supply chain shocks that we've seen as companies are trying to reopen and catch up with demand. But if you look at what most are saying out there and what the numbers are starting to show is this certainly more likely than not will be a shorter term phenomenon heading in toward the end of the year and maybe even into early next year. But those trying to compare it to what happened in the late 70s, early 80s will probably be a little bit disappointed. The tools are there, and the numbers right now as we trend into the summer are supporting a shorter term impact of higher and slightly higher inflation, but forecasting to be well below 3% on average by the end of 2021. And the other piece certainly being the virus and the Delta variant and what that's done in terms of not only infections and the medical, the headline numbers that were trending, but just behavior. How will that impact people's behavior and the decisions that they're making as they go out and try to travel and spend and get back to normal from what had already happened about a little over a year ago. So that's something to watch, and neither are presenting themselves as concrete certainties right now. But just as we look towards the next quarter and into the fall, those will be two things to keep an eye out for, and how the market reacts. And a final note, as you look at what else is happening outside of the markets and chatter about inflation and the economy, there's finally now you're hearing of some action in the political arena, as we normally do towards year end. And although, like we said in the first quarter webinar, when talking about a new administration coming in and what that means, every president, every new cabinet has a list of agenda items and things that they'd like to do. And when you have that kind of a change in administration and the political dynamics, you have to sit back and say, okay, well, how do we put on our hat of being a historian and compare where we are now to some other period of time? And what does today look most similar like as we go back in the 100+ years of history we have, and what might that mean for investors as it relates to some of the hotter topics being thrown out there? And I think the big thing that you're hearing of, especially today with the Senate taking a vote, is the infrastructure plan put out there by President Biden, and it's something that's been negotiated via political ping pong for a couple months now between Republicans and Democrats, but something that looks a little bit more real in terms of its likelihood, even if it's a scaled back version of passing, before the end of the year. So something that caught our attention as a point of comparison in time across different dynamics in the market and the economy is, today versus post World War II, and it's not often that you get these kinds of side by side comparisons that make sense. But this is, looking on the left, the end of World War II, and on the right, post COVID-19, shutdown of last year and reopening. What are some of the comparisons we're making and things that we're seeing that might help us lead to believe that the markets are in for some new dynamics in the future, which Andy will talk about. But, we had a sharp manufacturing decline and recovery in both instances. In both cases, we had public debt, debt to GDP well over 100%, which is part of a lot of that stimulus we had flood into the markets last year. And we had a lot of fiscal support. Certainly, you had the GI Bill and the Employment Act of '46, but now we've got the three-part Build Back Better plan from President Biden, which was the first part of the COVID stimulus that he rolled out, now the infrastructure plan, and the third part being the American Family Plan. And you had a very accommodated Fed with cap on treasuries post-World War II and QE and zero interest rate policy today. And the big piece, the two big pieces of this really to highlight are banks and the financial system in better shape than they were before. Back then we were coming out of the Great Depression, and now we're still recovering fully from the global financial crisis. And, having that backdrop with accommodative policy from the government and the Fed, and a really strong consumer with household savings rising, as I said, some of those things were also prevalent back then. And so the dynamics, we think, although it's not always apples to apples comparison, but you can see on the right what this meant for asset class returns back then and what it could pose for us now. And I think this just continues to highlight the case, certainly for value, as we look at an environment of a continued growing economy and slowly rising rates and inflation over time. And Andy's going to talk about that, and certainly what we're seeing within our allocations and portfolios. And he's also going to talk about cryptocurrency, which is a big topic we're hearing from clients. So Andy, I'll pass it over to you.
Yeah, thanks, Adam. Yeah, and that's certainly the case. I do want to dive a little bit deeper into U.S. stock returns really over the past year and a half, and then give an update on our investment strategy as the next part of this webinar. So I don't think this is news to anyone, and we've covered this on our webinars in the past. But the first 9 months of 2020 were all dominated by large growth. And I like to zoom out here and take a look at this, because we all follow the day-to-day news in the stock market. And sometimes it's instructive to take the step back and really try to see what the trends are like. And I think that when we get an exciting market like we've had over the past 18 months, there's lessons that we can learn from that. So as you also know from our previous webinars, we made a strategic shift at the very end of March and the beginning of April to lean into small caps. And we already had, a tilt into value at the same time. And one of the hardest parts about investing, one of the biases that are out there in the behavioral finance literature is something called the recency bias. And the recency bias is just the tendency to see whatever's happened most recently as more likely to continue happening. So here we are in the month of April, and we're tilting in towards small value. Then we get to May and June. We're deeper into the summer in July and August, and that bet's not paying off yet. So it certainly would have been tempting to shift into the pandemic trade and buy some of those pandemic darlings that were doing so well through the summer of 2020. But making a shift at that time would have been, the worst timing possible. Because as we can see here over the next 9 months, once we get to October, small value really kicked in strongly. So I share this mainly because I think one of the lessons that we've learned, and we are certainly not immune to the recency bias. It's a bias that affects all types of investors. And so this is, reaffirming to us, but it's so important to have a sound predefined strategy and then stick with that strategy to achieve those types of gains. And so the performance really over the last 9 months, and I think you've seen the performance in your portfolios as being relatively strong over that time. It really highlights that patience, and that patience is typically rewarded with investing. Now, small value has done quite well over the past 9 months. So it's a natural question to ask, well, can that continue? And especially when we get to a month like this past June, where large growth actually was beginning to outperform small value, the question is, what are we doing? What should we do? When should we come off the value tilt? And I think that in times like these, it's nice to look at history to sort of inform our opinion here. So from 2012 to 2014 was the last time we saw small value outperform large growth for an extended period of time. And these are the month-to-month returns. So as you can see, it's somewhat unusual to have a string of months that month after month, a certain size and style segment continue to do better. And over this entire time frame, small value did hold the edge over large growth, but 6 out of the 20 months here were counter trends where large growth had the advantage. So it's typical for any size and style phase to be punctuated by brief counter trends the other direction. Now, once momentum is established, it does tend to be self-fulfilling, but the upshot here is that you should expect that some months for that not to be the case. So I think when we look at the previous chart where we saw June was a pro large growth month, that's not a reason in and of itself to move on. And in fact, we are currently in the early innings here of a pro value market phase. This is the wave chart that we've shown in the past. I'll briefly explain it again. So, when we're above the origin over the last 12 months, value stocks outperform growth stocks. And when we're below the origin, growth stocks outperform value stocks. So, as you can see here, we are in that pro value market environment. And these phases tend to be measured in years and not months. So the fact that it's been 9 months or so, we would still expect value to continue outperforming. And so we are maintaining that tilt towards value in both of our primary strategies, both size and style responsive and the master portfolio. In times like these where we are tilting kind of into value and a little bit into small caps, SSR and master are going to look pretty similar. So, what I'm talking about here really does apply to both of those strategies. And so from a momentum standpoint, we expect value to outperform, but what about a fundamental standpoint? We've shared this a little bit in the past where if we go back a little bit, specifically to September of 2020, and we look at the spread between the valuations of growth companies and the valuations of value companies, it was historically wide. In fact, we're talking about like 99th percentile, almost unprecedented amounts of dispersion between value and growth. And the thing about the market is markets tend to be pretty efficient, and regression to the mean is a powerful force. So I was wondering about this, to see where we are now. And interestingly, despite the big run that we've seen out of value companies, we're still somewhat historically cheap when it comes to looking at value companies. So, we're not quite the 99th percentile anymore, but we still are the 94th percentile. And so what this implies is that value is a great deal relative to growth, and that there's a strong fundamental case to be investing in value names in addition to the momentum piece. So now I'm going to switch gears completely and move to a topic that I think has been top of mind for a lot of people. And that's the topic of cryptocurrencies. So, we are in the middle of another big crypto cycle where things like Bitcoin see huge price movements up, and we're sort of on the downslope of that now, it seems. And whenever this happens, the topic comes to mind again, and we're always asked if clients should be investing in it. And I think that a lot of advisors out there really shy away from this topic, either because they don't understand it completely, or it's just not investable on the major custodial platforms yet. But there's clearly a lot of interest, and we want to make sure we address that head on. So I wrote a blog post on this on my personal LinkedIn page last month. And the whole premise there was really how you should think about an investment in crypto. And the first thing I recommend doing is differentiate between the technology and the investment, because those two things really are different. And there's no doubt that crypto, from a technology perspective, is exciting. And I think one of the big differences between the last crypto bull market and this one is that we're actually seeing legitimate use cases. I think in 2017, it was easy to call Bitcoin, fake internet money, because there really wasn't anyone using it for anything. It was really just being used for speculation, at least in this country. And sure, there's still an element of that today with things like Dogecoin. But there are also real use cases that are expanding beyond just the crypto universe. So I think one of the terms that really exploded in popularity was NFT. And, if we had this talk back in 2017, I doubt anyone on this call would really know what an NFT is. And I bet now that more of you do. For those of you who don't, it just stands for non-fungible token. And it's one of the ways that true ownership over digital files like image files or video files can be done. And so now we're seeing artists make digital art and selling it, for hefty sums of money. My favorite sports team, the Washington Capitals, are actually selling NFTs. So, that's an example of how this is going beyond, just the crypto investment sphere and actually into everyday life. And of course, there are many other use cases out there that are, and many others that are still being developed. So as I mentioned, crypto is exciting, but exciting doesn't always mean great investment. So I think, one of the reasons people are so interested in crypto is it is difficult to think about, but I think we can remove some of the mystique around it if we view it from the lens of something a little bit more familiar. So what I recommend doing is view crypto as just another asset class, like stocks or bonds or cash. So if you're considering an investment, you want to consider it alongside your portfolio as a whole. And sure, on the scale of something like the stock market or the bond market, crypto is brand new. But it does have a long enough track record where we can begin to pick out some trends. So in traditional finance, we think of stocks as being the riskiest asset class, but also having the highest potential returns. Crypto should be viewed as much riskier. There's a major bear market in stocks that happens, on average about every 5 years, and a bear market is defined as a drop of 20% or more. Bitcoin can be expected to drop by 80% on the same frequency. And while there are circuit breakers in place when stocks violently sell off, as we saw during March of 2020, there's no such protection in the crypto space. Bitcoin dropped 35% in one day during the COVID crisis. No breaks. And yes, Bitcoin has outperformed the S&P 500 by orders of magnitude over the past decade, but it does also look like the perfect behavioral trap. So here we have Google search interest plotted alongside the price of Bitcoin. And as you can see, Google search interest spikes as the price of Bitcoin spikes. And what this implies is that interest and likely investment is increasing just in time for prices to fall. So while, yes, investment returns available are quite high, it's likely that the typical investor returns that are achieved are much lower. So yes, there's a lot of money that can be made investing in crypto. There's also a lot of money that can be lost investing in crypto. And I don't mean, to take a stance pro or against here. But one of the things that we want to leave you with is a list of questions that you should ask yourself before you make an investment. And this is really a list of questions that might look familiar because it's the same list of questions that you should ask yourself when making a decision on any investment. So, do you understand how it works? What are you trying to achieve for your portfolio? How did you react last time stocks fell? How will a large drawdown affect your portfolio and long-term financial plan? What is the right target allocation and rebalancing schedule? Are you aware of the tax consequences? Access is going to get even easier as it seems that the SEC is going to approve crypto ETFs either later this year or next. In Canada, these have already been approved. So it's really important to differentiate between crypto, the asset class, and crypto, the investment. In the end, the decision to add it to your portfolio will be personal and be driven by individual tolerances for risk and investment goals. We'll send out a link to my blog post as a follow-up along with the recording of this webinar. But if you want to look forward, you can also find it on my personal LinkedIn page. Just search Andy Pratt on LinkedIn and you should be able to find me. And if you read that post and decide you want to go down the crypto rabbit hole, we do have additional pieces that go even more in depth that we think you should read before making any investment decisions. If that is you, please reach out to your advisor and they'll be happy to share these pieces. So for Lowell and Adam, I want to thank you all for joining us today. And again, please keep an eye out for that replay. And once you do get it, please feel free to share this webinar with anyone you think might be interested. Thank you and have a good day.